Good afternoon. My name is Nathan Erickson. I'm the Vice President of the Phoenix CFA Society. Today's webcast, entitled The Great Confusion, Reflections on Mean Variance Optimization with Harry Markowitz, is brought to you by CFA Societies of Arizona. This is a joint partnership between the CFA Society of Tucson and Phoenix. And we'd also like to thank the CFA Institute and the CFA Institute Research Foundation for their support. I'm joined today by Dr. Harry Markowitz, economist and winner of the John von Neumann Theory Prize and Nobel Memorial Prize in Economics. Good afternoon, Dr. Markowitz.
Good afternoon.
I'd like to start, Dr. Markowitz. You once told me that one of the best compliments you ever received was from famed investor Peter Bernstein. Can you share that with us?
Yes. Peter Bernstein and I both were on the advisory board of Rob Arnott's, First Quadrant was perhaps, or research affiliates, but we were consultants or advisors on the board of advisors to Rob Arnott. This was at one of the annual meetings where Rob Arnott has his advisors, but also his clients and his potential clients and his staff all together at some nice location. And as part of the discussion afterwards, not as his formal, not as his in his prepared remarks, but in his informal comments afterwards on somebody's paper, he said, "You don't know what you young people," which was everybody except him, "you young people don't know what the institutional investment process was before 50. And he said that people would sit around a table and talk about what industry they thought would go up or go down, or whatever stocks they thought were hot or had information. And it was very much like the uninformed individual investor would do now. And then he said, "And now you have a process." And then at that point, I sort of realized what I had started. There is a process. Now, the process isn't just mean variance analysis. There's this Gary Brinson and colleagues, one set of colleagues or another, talked us into a top-down analysis where we started, where what's typically done for trillions of dollars, literally these days, is to do a risk-return analysis at the asset class level and then decide how to implement it in terms of ETFs or investment companies or money managers or what. So that's part of the process, but that process itself depends on data that we didn't have in 1952 when I wrote my 1952 article. The Ibbotson series, now Morningstar of course, and models of covariance like Bill Sharp's one-factor model and Rosenberg's many-factor models and so on. All these have become part of what has become the process which we all share.
Yes, and I would guess that the majority of our viewers would agree that modern portfolio theory has been the foundation for portfolio construction over the last half-century. But what we've seen since 2008, it's come under criticism primarily that it didn't offer protection against a global market crash. And that's really the topic of our discussion. So I'd like to take some time and reflect on that thought.
Let me tell you a little story. My wife is a morning person. I'm a night person. She usually goes to bed by 9 o'clock, 9 p.m., and I go to bed 2 a.m. So we have 5 hours to write books, read books, and so on and so forth. When we're in Las Vegas, she goes to bed about 10 p.m. because we saw a show or had a late meal. And I tell her as I leave, I'll be back by 1 a.m. So I was down. My objective in Las Vegas is to lose as little money per unit time while soaking up the ambience. So I was down playing some vertical roulette, spin the wheel, bet 5 because I'd win a few, and I know I'd win a few, lose a few, and I noticed that the couple of guys that were also at the same table had English accents. So I I said, you know, I started a conversation, and it turned out one of them was an investment banker in London, at a small bank, investment bank I hadn't heard of. And I said, do you know about portfolio theory? He says, MPT, of course I know about modern portfolio theory. And I said, you know Harry Markowitz? And he said, well, I haven't met Harry Markowitz, but I know of. So I reach into my wallet, take out my driver's license, and I say, I'm Harry Markowitz. And he says, you're not the real Harry Markowitz. I said, I am the real Harry Markowitz. You're not the real. I am the real. But finally, I say, ask me a question about portfolio theory. He says, does portfolio theory still work during crises when all correlations go to 1? And I said, in 2008, large cap stocks, the S&P 500, went down 38%, plus or minus, depending on whether you include dividends. So the large cap went down 38%, let's say, whereas emerging markets, emerging market equities, which has a higher beta, went down more than 50%. And of course, corporate bonds just went down like 5%, and government bonds went up. So at this point, he said, okay, you're the real Harry Markowitz. Now, the next thing I know, and I notice he's dialing, he's punching something into his cell phone. I said, are you Googling me? He says, no, you're the real Harry Markowitz. I'm calling my office in London. It's after 8 a.m. in London. I need to talk to my office. So he's off talking to his office. And he comes back, he says, they want pictures. So we went off to the side and took some pictures. Okay, but if you notice carefully, I really didn't answer the question that he raised, namely, does it still work when all correlations go to 1? What I did was answer the easier to answer, but I'll answer the other one too, for you guys, not for him, for you guys. I answered the question, does it still work when all asset classes move in the same direction? And my answer is that yes, they move in the same direction, but not by the same amount. And the amount that they move is roughly by their beta, roughly, plus an idiosyncratic term, presumably. And so that if you were high on the frontier, up, on the risk-return trade-off curve. Everybody here knows what a efficient frontier is, of course, I hope. Well, if you were high on the frontier, you got hammered. And if you were lower on the frontier, you didn't get hammered in 2008, but on the average over the long run, you wouldn't have done as well. But, okay, so I answered the question, does it work when all asset classes move in the same direction? And yes, you've paid your money, you've taken your choice, and 2008, the large cap stocks, the 38% move, that was approximately a 2.5 standard deviation move. Now, if distributions were normal, they're not, but if they were normal, then you would have 5% of your probability distribution beyond 2%, I beg pardon, 2 standard deviations. Did I say that 2.5%? I meant a 2.5 standard deviation move, is what I should have said. Okay, well, if they're not, but if distributions were normal, then you would have 5%, beyond 1.96 standard deviations, the mean plus 2 standard deviations, the mean minus 2 standard deviations. Between that, beyond that, you'd have 5%. So the bad side would be 2.5%. So it was a 1 year in 40, not a 1 year in 1,000, 1 year in 40 move. And I've been in this business for 60 years, so you should expect a 1 year in 40 move once in a while. Okay, so it was not a black swan. It was not, it was not a huge mini standard deviation move. But anyway, I answered the question. What I answered to him was, does it work when all asset classes move in the same direction? And the answer is yes, but not by the same amount. And implicitly, you should have chosen your risk-return combination in advance, and now you know what a standard deviation, a 2 standard deviation, 2.5 standard deviation move feels like. Maybe you'll reconsider where you should be on the frontier, but okay, that's another story. But what about all correlations going to 1? Well, let me simplify, explain this. I'll take a little cup of coffee here. Excuse me a second, folks. Let's simplify. Instead of talking about full arbitrary covariance matrix, let's assume Bill Sharp's one-factor model, Bill Sharp's 1963 simplified model of portfolio selection, which says all securities move up and down together because they all are dependent on some underlying factor, which we usually call the market. It isn't the CAPM necessarily a cap-weighted market. It's just some kind of underlying systematic risk, some underlying factor. Now, the correlation between two securities depends on their betas and their idiosyncratic terms and so on. But let me simplify. Suppose you have two securities, both with beta equal 1, and both with the same idiosyncratic risk. So that, in other words, the one-factor model says that the return on the I security is an alpha sub I plus its beta, not its CAPM beta, but a regression beta. It's beta times the factor plus a idiosyncratic term. Suppose now we have two securities which have the same, which have beta equal 1 and the same idiosyncratic risk. Ask my assistants here. I've got to. So for that, for two such securities, their correlation is equal to the variance of the underlying factor. Let's say the variance of the market, the volatility. Now this is variance. That's volatility squared, but it makes no difference. Those who know what the variance is will interpret this precisely, and those who don't will get the general idea anyway. So you take the variance of the underlying factor and divide it by the variance of the factor plus the variance of the idiosyncratic risk, and that's the correlation. Now, if the variance of the underlying factor, if the systematic risk, the F, the variance of F swamps variance of U, then you can see if in fact if U was V of U, the variance of the idiosyncratic term, was negligible, then correlation would be 1. On the other hand, if keeping V of F fixed, if you make V of U larger and larger and larger, then the correlation approaches 0. So so what happens in crises is not only do all asset classes start off in the wrong direction together, but then the people decide, oh, we're going to miss the bottom, and then the market goes down, the market goes up, the market goes down, the market goes up, market goes way down, and then it comes way up and has to stay. And so not only do things on the average move in the wrong direction, but the markets become more volatile. So, of course, ex post, afterwards, we can see that the markets have been more volatile. Like we can see afterwards that the market has gone down, and other times we can see afterwards the market has gone up. But unfortunately, we have to invest ex ante, not ex post. So, you make your forward-looking estimates. If you think the market is about to go to more wild times than average, you should adjust your forward-looking estimates accordingly. And ex post, if there is an extra wild time, then the ex post measurements of correlations will be closer to 1 ex post. So it's all consistent with portfolio theory. the door open, please.
So one of the other questions, Dr. Markowitz, that I'd like to ask, and I want to remind viewers that the chat window is open. If you have questions to submit, we can see them and pass them on. But as markets have grown and matured, we've seen the introduction of additional asset classes, some with non-normal distributions. Does the process for mean variance optimization change with the input of, say, alternative asset classes?
Well, there's two parts to your question. One is, suppose you have more and more asset classes. Is the process different? And the other is, suppose you have asset classes with non-normal distributions. Suppose you have individual investments like puts and calls and things like that with non-normal distributions. How does that change the process? Now, first, the easy part is, hang on a second with my whistle. The easy part, if you have more asset classes, then you have a larger universe. But you, for any security, if you're doing it at the security level, or at the for each asset class, if you're doing it at the asset class level, somebody has to make forward-looking estimates of expected returns for each security or asset class, estimates of the variance or standard deviation of return for each asset class, and estimates of the correlations between them, explicitly or implicitly. And what I mean by that is you could use a factor model if it's more convenient, if you've got a good one, rather than use rather than using forward-looking correlation coefficients and so on. So having more, the mean variance process is the same whether you have, you're doing it, whether your universe of investments are, threefold stocks, bonds, and cash, or 3,000-fold, Russell 2000 plus Russell 1000, 3,000. It's still, you have to supply these inputs. You supply some means variances, covariances, and constraints. Like, I don't want to put too much in emerging market, because if it's I'm a financial advisor. I don't want to put anybody too much in emerging markets because it's very volatile. If there's a bad bounce right out of the, stumble right out of the gate, he's going to say, he or she's going to say, that's a stupid asset class. Oh, must have a stupid advisor. Let's get rid of him. So the process consists of having a universe of, quote, securities or asset classes or what have you, supplying means, variances, and covariances, and maybe that's done with a factor model for these, having constraints, having a mean variance efficient frontier, and then putting the guy, one of the most important parts of the advice process is to get the guy on the right place on the frontier, not just close to the frontier, but the right part of the frontier. The widows and orphans at this end, and the young business people at the end, at that end. Okay, but what about if you have non-normal securities? Does mean variance still work? I have two screens. I see me on one. I don't see you guys on one. And the other one says, "Welcome to the Great Confusion: Reflections on Mean Variance and Optimization with Harry Markowitz." So what is this thing I call the Great Confusion? And I'll put something up on the screen, and it will be visible to you. There we go. These are from a PowerPoint talk I give, extract from a PowerPoint talk. Our field is plagued by a great confusion, namely the confusion between necessary and sufficient conditions for the use of mean variance analysis in practice. Normal or Gaussian return distributions are sufficient to justify the mean variance analysis. They are sufficient conditions. If the distributions are normal, then you can use mean variance because the mean and the variance are the sufficient condition. But Gaussian distributions are not necessary. Now, if you believe, as I do, that the rational decision-making should be consistent with expected utility, the way von Neumann and Morgenstern defined it, but the expected utility maxim, then the necessary and sufficient conditions for the use of mean variance analysis is that if one were to carefully pick a portfolio off of the mean variance efficient frontier, one would, an expected utility maxer would approximately maximize expected utility for a great variety of risk-averse utility functions. Now, I never assumed, not in my 1952 paper, not in my 1959 article. Excuse me a second, folks. I'm taking another little sip of coffee. I never assumed that distributions were normal, and in particular, in my 1959 book, Portfolio Selection, Efficient Diversification of Investments, my 1959 book, I argue in chapter 10, the fundamental assumptions of my book are at the end, not at the beginning. Now, the reason I put the fundamental assumptions of my book at the end, not the beginning, is because if I had started the book with an axiomatic treatment of the theory of rational decision-making under uncertainty, nobody with money would have bought it. So the fundamental assumptions are in the back. And in particular, in chapter 10, I talk about the expected utility, the expected utility rule in between chapter 10 and chapter 13 and chapter 6. I talk about mean variance approximations to expected utility. If you, for a great variety of utility functions, if you, and for historical returns on portfolios, if you know the mean and variance, you can guess the expected utility. So that was the argument in 1959. A large number of subsequent research papers by me and others been generally supportive of this conclusion, subject to some caveats, which we now understand. This line of research, a very substantial line of research, which has to do with mean variance approximations to expected utility, whether distributions are normal or not, as I say, is very supportive of mean variance analysis, but seems to be completely unknown to textbook writers. Let me give you a few references. I'll tell you a little bit about it. If you're going to read one paper on the subject, I would recommend that you read Levy and Markowitz, 1979, Approximating Expected Utility by a Function of Mean and Variance in American Economic Review. So this is 20 years after 1950, I'm sorry, did I say 59? It's 1979. Levy and Markowitz, 1979, which is 20 years after my mean variance book, my portfolio selection book. And it finds that using what Chaim Levy and I did with the help of Yoram Kroll doing the computations, we took 149 investment companies, which were all in existence then, according to Wiesenberger, that had, I think, like 10 years worth of history. Now we have more investment companies than we have securities, but we took the 149 investment companies, looked at their 10-year history, return history. We pretended that those were probability, 149 different probability distributions, and we looked at the correlation between actual utility, for various utility functions like log utility and power utility and exponential utility. So for various utility functions, we found that there was a very high correlation, like 0.995, sometimes 0.999 over the 149 different distributions between average utility, expected utility, if that's the distribution, and the mean variance guess. So if 0.995 correlation isn't enough for you, you should be in a different field. We found that there were some utility functions which were pathologically risk averse. They'd rather where it didn't work, that somehow mean variance approximations broke down. But these were ones where a person would rather have 6 or 8 or 10% with certainty versus having a 50-50 chance of zero return, no gain, no loss, versus a blank check. You just write any, you trade your wealth for anybody, Microsoft. Anyway, so U.S. debt. You got this asset, not a liability, of course. Okay, so except for these rather strange utility functions, we found mean variance approximations work quite well. I'll take the slide again. Okay, so Simon, Yusuf Simon, wrote what is the opportunity cost of mean variance investment strategies. He said, what is it worth out of the portfolio what is it worth out of your portfolio to have the true optimum rather than the mean variance, mean variance second best, as he calls it. And except for these weird utility functions, the cost, the opportunity cost of using mean variance was trivial. And for these weird ones, if you have a risk-free asset, then it again is trivial. So the obvious conclusion from Simon is, if you got pathologically risk-averse investors, have a risk-free asset there. My favorite paper is by Lewiczka, Walter Lewiczka, The Empirical Nature of Taylor Series Approximation of Expected Utility, American Economic Review. So what he did was to see how well mean variance approximations worked for portfolios of calls. Now, there's a little caveat. His portfolios of calls always had had 10% investment in treasury bills, so they can't go to zero. So but given this as a caveat, he found that even with portfolios of calls, now individual calls, mean variance approximation is lousy, but for portfolios of calls, mean variance approximations do perfectly well. So that's Lewiczka, H-L-A-W-I, and so on, Polish, obviously. 1994 American Economic Review. Okay, there's a paper coming out in the Journal of Operations, in the European Journal of Operations Research, mean variance approximations to expected utility, a survey. But I got a better reference for you. If we could, I'm sorry, I have the next page here. If we could look at the next page. And now we want to look at it. Now, what I want to call to your attention, lots and lots of, this comes from the PowerPoint of a talk where I say the remainder of this talk will briefly summarize the last reference, which is essentially chapter 4 of. Now, forget, there won't be another letter. We're doing questions instead of a lecture, but I dragged out these old PowerPoints. But I want to call your attention to Markowitz and Bley, 2013, Volume 1. It's called Risk Return Analysis, The Theory and Practice of Rational Investing, Volume 1. So I'm now in the process of, hang on a second, I'm going to take a little sip of coffee, wet my whistle. I'm now in the process of writing a book, which was to come out in 4 parts. It still will have 4 parts, but at the suggestion of Frank Fabozzi, some of you may have seen some handbooks of his, at Frank Fabozzi's suggestion, since each of these parts was becoming quite large and turning out in 4 volumes. Volume 1 is now in the hands of McGraw-Hill, should come out in the fall. Volume 2 is due at McGraw-Hill in March of 2015, Volume 3 2017, then Volume 4 2019. So I'm booked out till I'm 91 years old. Anyway, so the Volume 1 of this book corresponds to Chapter 10 of my 1959 book. So it's the theory of rational decision making, single period, known odds, and you can move that. The first chapter is about why we believe in expected utility. The second chapter surveys this literature on mean variance approximations to expected utilities. The third chapter says, if you know the arithmetic mean and standard deviation of a distribution, how do you best guess its geometric mean? Of course, it's the arithmetic mean which must be the input to a mean variance analysis, because the arithmetic mean of a weighted sum is the weighted sum of the arithmetic means. So that's why it's got to be the input and output of a mean variance analysis. But geometric mean is what you get in the long run, and I take 6 different rules for approximating mean variance. 6 different rules that are used for given the arithmetic mean and variance approximating the geometric mean. I see which one it was. The 4th volume is an interesting little thing I'll tell you about. It has to do with different. Hang on a second. It has to do with different ways of approximating the expected value of the logarithm. I think we need a little higher, don't we, John? No, just upright. No, that's fine. There we go. There's different ways of estimating the expected log. Why expected log? Well, this is when Daniel Bernoulli first came up with the notion of utility analysis. It was the logarithmic utility he proposed. Also, there's a close relationship between the expected value of the log and the geometric mean. The geometric mean of a return distribution, or the log of 1 plus the geometric mean, is the same as the expected value of this Bernoulli utility function. I use various ways, I did risk return approximations to logarithmic utility, and I use various functions. I did linear combinations of various expected return and various risk measures, like variance, on MAD, which is mean absolute deviation, and semi-variance, and value at risk. And the distinction between raw and interpolated has to do with if you have a finite number of observations, where exactly the 5% level falls depends on whether you think it's a continuous distribution and you interpolate, or a discrete distribution and you use raw var, and then CVAR, conditional variance at risk. And I looked at the ability of these various measures to approximate or to approximate the expected log, which equivalent to geometry mean, the expected log of various historical distributions. In fact, I used two databases. One was in the first column of numbers, a database of frequently used asset classes, large, the Ibbotson, Morningstar, stocks, bonds, bills, and not inflation, and emerging market and EFA. CM1, CM all asset classes, and the other was the real returns, because the database. This is the London Business School returns, and at that time it was 16. He's since made it 19. 16 different countries from 1900 through 2000, the 20th century, 101 years, the London Business School. There's a book called Triumph of the Optimist. Triumph of the Optimist. We'll go back to the Triumph of the Optimist, which where you'll see this the means, variances, and standard deviations, and so on, geometric means, and so on of these distributions, and we use real returns because this data included the nominal return included Germany in 1923, where you could get a billion% on your money, but don't try to spend it. Okay, so what I've plotted here is the root mean squared error over over these various returns of these various databases by the one measure and the other. This will be, as I say, this will be chapter 4. There is an article out somewhere, but this will be chapter 4 of the forthcoming book, so you can see all the specifics of how these were all measured. But if you'll notice that making a linear function of mean and some measure of risk, or some function of measure of risk, in the first column, the lowest mean squared error is when you use variance divided by 1 plus expected return squared. The second is just plain variance. Third is semi-variance, one way or another. Over in terms of these really wild swings that happen in these 16 countries, like Germany had a negative and had a real loss of 90% right after World War II. Japan loss of 80%. Italy like 70%. So don't start a world war and lose it. It's very bad for your wealth. All the methods had more difficulty with that asset class than with the commonly used, with those series than with commonly used asset classes. But still, the best on the list happens to be variance. The second best on the list happens to be variance divided by 1 plus e squared, and the others are also RAND. So that'll be it for me. It is not, normal distributions. It is commonly said, not by me, but by a lot of other people, that if you don't have normal distributions, or if return is not linear related to something else, you can't use mean variance. Well, that's wrong. I can think of a two-word, more pungent expression, but I don't think we ought to use pungent expressions on a family show like this. So that's the answer. That is my long answer to your short question.
Great. Going off a couple questions we received online, let's talk a little bit about the application of mean variance optimization. One question we had was, number of return data points that you would need for a valuable series. If you're using monthly data points, how many years of data do you need to be able to input that mean and variance assumption into the model? You can comment on that.
Now, the inputs to a mean variance analysis should be forward-looking estimates. Now, how do you make forward-looking estimates? Well, first place, one of the distinctions you should make is between a particular vehicle, let's say an ETF, and the asset class which this ETF, the asset class or asset classes which this ETF is supposed to track. Suppose spiders had just come out. It's a year after the introduction of spiders. So you have 12 months of data on spiders, and you have data back to 1926, let's say, on large cap. Okay, you should be using the data back to 1926 on large cap plus some estimate of tracking error. So there's a question of what data are you supposed to be using. Okay, now suppose because so I guess implicit in what I'm saying is that you do not have to, and in general, without thinking about it, you should not just use any past back series. Like, for example, suppose that the average return to T-bills since 1926 has been, if I remember correctly, 3.5%. Well, your forward-looking estimate of what you're going to get for T-bills this year is not 3.5%. It's zero. Rounds off to zero. Okay, it's close enough. Okay, so these are supposed to be forward-looking estimates. So if it were true that nature was drawing from the same bushel basket over and over again, then and the means and variances and covariances were statistical, then the standard deviation of your estimate of the mean goes down by the square root of the sample size, and that's if. That's if. Again, let's go back to the part 4 of my book, the 1959 book. Chapters 10, 11, 12, 13. Chapter 10, Theory of Rational Decision Making, Single Period Known Odds. Chapter 11, Theory of Rational Decision Making, Many Periods Known Odds. First was single period, many period known odds. Chapter 12 has to do with single period, multi-period, makes no difference. Unknown odds. And what I endorse there is a view which I learned from my professor, Leonard J. Savage. It's called a Bayesian view. One should maximize expected utility, like if you, but using probability beliefs where there are no objective probabilities known. And you shift these beliefs according to Bayes' rule. So I don't have a formula here for to hold up about what Bayes' rule is, but you can look it up in all sorts of books. Okay, so we're supposed to be shifting our beliefs from priors to posteriors and so on. One article of mine on that has to do with Richard Michaud has a book on resampling, and I have an article with Nilofer Usman about whether you would be better off with certain length of time series like he used, using his resampling or Bayes' rule using diffuse Bayes and his rule actually beats diffuse Bayes' priors. The door's quite hot. And can we leave that open? It really is quite hot here. Excuse me, we're in there's three of us in a small room with lots of lights, and I'm getting hot. Of course, I always get hot when I start talking about portfolio theory. Anyway, the brief answer to your question is I don't know, but in principle, we should be shifting our beliefs according to Bayes' rule, and that means our forward-looking estimates of variance are not necessarily our best guess as to what variance is, but should also reflect our uncertainty of what the expected return is. That's a good question, thank you.
Yeah, and as a follow-up on that, maybe can you comment on how the structure of markets and economies, how they've changed recently with the advent of quantitative easing across the world, and how that impacts your assumptions, your forward-looking assumptions?
Yes. Now, it's still true that you're supposed to make forward-looking assumptions of means variances and covariances, but with money being pumped into the world, let's see, my official position is I don't predict. I don't try to predict what the market is going to do. As a working hypothesis, I say the market, the stock market, the bond market, obviously you look at what current yields are and you figure there's a move from there. But as far as the stock market, as a working hypothesis, so once a year, nature draws a return on the S&P 500 from a bushel basket, whose distribution is like the Ibbotson series, which is up on my wall someplace in another room. Okay, so that's my official position. But as for sort of guessing which way the market is, probably not with certain, but sort of probably going. I was very much influenced by, for many years, many years, by a book by Beryl Sprinkel, Sprenkle, or Akle or something like that. Beryl Sprinkel, who was way back when, maybe in the 60s or something, 70s, was asking, why is the stock market a leading indicator? Because all the research that has been done shows that stock market forecasters can't forecast. So how can the stock market itself be a leading indicator? And his explanation was, well, when things are bad, when the market is down, the Fed starts pumping money into the system. And that money, in the first instance, doesn't go into real investments. It goes into liquid assets like stocks and real estate and so on. And so you have, the market turn around before the economy does, because the money is flowing into the markets. And the market starts rising, and then finally maybe the economy starts moving, and then all of a sudden the Fed says, wait a minute, I think we've gone too far, and it starts putting the brakes on. So the stimulus always happens before the real economy, when the real economy is bad, and it takes a long time to turn around that big ship. And the liquid assets get it first. The stock market, the bond market, the stock market, the real estate market, the art market, whatever's popular. And then, of course, you can slam on the brakes, and then the market starts coming down before the real economy goes down. So, everybody assures us that let's see, I have two pieces of news, old news and new news. The old news is quantitative easing is still here, and the new news, hot off the press, well, it's a little later now, but as of 10 o'clock or 11 o'clock West Coast time when I left, the Dow and the S&P 500 were making new highs.
So in terms of structure of markets, we've had a couple of questions about how rhythmic trading or high frequency trading, dark pools, does that affect the ability of investors to use mean variance optimization or its effectiveness in portfolio construction?
Let me say, I'll come back to that, but back before October 19th, 1987, and anybody who's, not terribly young should know, should remember that date. And young folks should learn what it's called Black Monday, when the market went down, daily move, 25%. It was a many standard. It was a black swan day. 1987, market went up, for the whole. So it wasn't that wasn't a black market. The United States has never had a black month, a black swan year, but October 1997 was a black swan day. Some of us said it was going to happen. That's because there was $90 billion being managed. And in those days, $90 billion was a lot of money. Not nowadays, but in those days, $90 billion was a lot of money. Okay, $90 billion was being managed by portfolio insurance, not portfolio theory, portfolio insurance. This was a simulated call on the S&P 500. The reason why you needed simulated calls is you couldn't buy $90 billion worth of actual calls on the S&P 500. And the way you simulated a call on the S&P 500 was if the market went up, you would buy. And if the market went down, you would sell. And you would sell it fast enough so that when you had lost what it would be the equivalent of your call premium, like 5% of your portfolio or 10, you would be out. So the way you could simulate this is sort of you're replicating the Black-Scholes curve by active trading, by active trading. Okay, but that means you're selling. You got $90 billion worth of stuff of people selling when the market goes down and buying when the market goes up. The market had gone down Wednesday, Thursday, and especially Friday, the week before Black Monday. On Black Monday, the people who were following portfolio insurance were supposed to sell $10 billion worth of the equivalent of stocks. They would do it on the futures because of liquidity. Of course, once everybody's trying to get out of these things, all the liquidity goes away. Of course, they were trying to sell, but the brokers knew the formulas. They were trying to sell first. They were front running. So they were supposed to sell $10 billion worth of the equivalent of S&P 500 stock, and by the time $5 billion, according to the Presidential Commission report on the market break, the very minute by minute, 15 minute, at least 15 minute by 15 minute reports of everybody who's doing anything. According to it, by the time that the portfolio insurers, not portfolio theorists, but portfolio insurers had sold $5 billion worth of stuff, the futures and the spot got so out of line, everything went to hell. By the time they had sold $5 billion worth of stuff, the market was in shambles. Now, how does that differ from the fast traders today? Well, one similarity is that they are using some kind of they're using some kind of algorithm. And the thing about the selling back in 1987 was as the stock market, as the presidential report reported, it was a price insensitive trading. No matter how much it went down, you still want to sell. But in any case, the one big difference between then and now is then there was a formula, and we knew the formula. And somebody who wanted to think through the consequences of the formula for the market as a whole could make their own, judgments. Now we don't know the formula. We know once in a while these rules have momentarily catastrophic effects, but we don't know the formula. So that's one thing that's different. The other thing that's different is the time scale. We're talking about what people calculated over the weekend they had to do on Monday based on Friday's close in 1987. Now the Wall Street Journal had a, hang on a second. The Wall Street Journal had an article, a couple of articles recently. One saying there's a loophole in the, I think it's the Chicago CME, so Chicago Mercantile Exchange software. So some people could get as much as a 10 millisecond head start on the other guys, which is terrible. And CME would say, well, try to really reduce that. My God, 10 milliseconds. Oh, what are you going to do with 10 milliseconds? Well, you can do something these days in 10 milliseconds. So that's different also. Okay, now what does this mean for the mean variance investor? Well, I have a friend who's John. I have a friend that says he's a long-run investor. He holds a position for at least 3 days. And he says that now when he goes into the market with these, there's usually a penny difference between bid and ask. So the markets have become very liquid for him. Of course, if the market starts falling apart, there's an expression which I guess, I don't know whether the young people know it, but the old people know, you do not grab for falling knives. If the market is falling apart, go back. Wait for another day. Wait for another minute. These time scales, gotta get my time scale right. So for John, my friend John, the markets have become very thick. But now, what about folks like Nathan, who's your moderator today? His firm advises the San Diego Symphony Pension Fund. I'm a member. I'm on the board of directors of the San Diego Symphony, and I'm the surprise, surprise. I'm on the pension fund committee. Well, I assume he considers re-optimizing maybe once a year or so at most. The information doesn't change that much. Well, no, I assume once a year is plenty. Maybe he rebalances once a quarter. I assume he has a trader that executes whatever order. He has traders that execute these orders that know that if things are going, well, first place you ought to have put limit orders in, and if things are falling apart in a handbasket, going to hell in a handbasket. So as far as my typical investor goes, pension funds and 401k people and so on that we execute for. We're using the facility of guided choice. My offices are not as secure as so we store my equipment here at Guided Choice. Just don't try to beat the market on a minute-to-minute basis. That's somebody else's game.
Right. Yeah. So for most mean variance optimization users, you're indifferent to the impacts of high-frequency trading. Maybe it provides liquidity, maybe it increases volatility on a daily or a weekly basis, but in terms of the estimates and assumptions that we're making, we're different.
Right, it's different. Just when you trade, have a trader who knows not to be in there. If once in a while the play, think of how many times we've had a flash crash or the equivalent, in the last year. Well, don't trade that.
Right. So a couple more questions.
Sure.
One around, we've talked a little bit about estimates and constraints. There's been growth in research in behavioral finance. So we did receive one question about what adjustments should be made for maybe a home country bias or around your constraints relative to the behavioral aspects of building a portfolio.
Well, there's two questions. One is behavioral finance and its impact. I mean, it's in our understanding. And the other has to do with home country bias. Excuse me. Okay, one of my problems is my short term. I'm 85. I never had a good memory. So if you ask me two questions, I'll forget the second one. So I'll answer home country bias, and then remind me about behavioral finance. Well, one of the explanations, maybe it's not complete, is that your liabilities, your cost of living when you retire, is going to be in dollars, not euros or pesos or pounds, and you ought to be doing. There is an article by Bill Sharp, by Sharp and Tint, way back when. I can't remember the name of the article, but in effect it says that it has to do with asset liability management and how you should really be minimizing the variance of the value of assets minus the present value of your liabilities. And if your liabilities are in dollars, then there should be some home. I'm sorry, that's Sharp and Tint. You ought to be matching assets. You should be doing asset liability management, right? I mean variance of assets minus A minus L, asset minus liability, period. And a natural consequence of that is if your liabilities are in dollars, then you should have a home bias. But there's more home bias than that. But, one of the things which a financial advisor should do, I should say that if you would like to know anything I know about being a financial advisor, other than using mean variance analysis, read the book by Roger Gibson on asset allocation. We both happen to be on a advisory board together for many years. He would explain how in his practice, before he would take anybody's money, he would talk to them to find out a couple of things, like what asset classes they would be comfortable with and how much drawdown they would tolerate before they chickened out of the program. And this would help him select the portfolio. And as I was saying before about emerging markets, if your client is going to dump you, if you put them in an emerging market and there's a bad bounce right out of the gate, then you're going to have to limit how much there is. Same with IFA. The client is going to be uncomfortable with IFA, then you have to limit how much you put in there. So it is true that there is a home bias, and there's both valid, rational reasons and behavioral reasons for it. In every case is an individual case. So now I still remember that you asked about behavioral finance. My favorite well, first let me tell you that the behavioral finance people consider me the father of portfolio theory and the grandfather of behavioral finance. Now, if you don't know that, and you've got a wealthy institution or a good library, buy the 3-volume handbook on behavioral finance by Hirsch Sheffrin. Volume 3 is historical documents, leading up to the modern theory of behavioral finance. And the very first historical document is what I call Markowitz 1952b. Markowitz 52a is portfolio selection, whose consequences Markowitz 1952b is called Utility of Wealth, and it has many things that anticipated the works of Kahneman and Tversky, and in fact Kahneman and Tversky cite it, and Hirsch Sheffrin not only has it as his first historical work, the grandfatherly work, but says nice things about it. Okay, but my favorite behavioral finance work is by Terence Odean. There's no apostrophe, just O-D-E-A-N. Terence Odean, and he has to do with small investors, individual investors, and well, in the first place, everybody knows that the chief problem with individual investors is they buy when things have gone up, and they assume it's going to go up more, and then they sell when things have gone down, and they assume that things are going to go down more, and so they're buying dear and selling cheap, which is not the right thing to do. But Terry has these analyses about there are active traders and inactive traders, people who sit and do day trades, and then there's people who got a portfolio and keep it. Now both classes over the whole population, both classes gross the same amount, roughly what the market does. But the guys who do a lot of trading, their broker makes a lot of money. They don't net as much. So I don't know whether I've really answered your question. Is there something more specific?
Well, I think you've said to me many times that portfolio construction, MPT, there's an art that accompanies the science, and a lot of that has to do with the fact that not all investors are rational. If you built a completely mathematically correct model, most investors would not be comfortable with the exposures, and that's really where the behavioral aspect comes in: is understanding your investor, yourself, and really knowing what are reasonable constraints to place on asset classes to build your model.
Yes, the mean variance analysis is a tool. If you try to use it mechanically, if you just use historical returns and you generated a frontier and you pick the growth optimum port or the maximum Sharpe ratio port or point off the frontier or something, you are going to do lousy. First place, we've talked about forward-looking estimates and how the forward-looking estimates of interest rates certainly are going to be different now. Then we've talked about understanding. Won't you leave that open, please, John? The understanding what asset classes your client can be comfortable with, and so on, and the kinds of constraints that you can put on his portfolio to make that he will live with, and so on. So both on the side of making your forward-looking estimates and choosing your constraints and finding and understanding where he should be, he or she or they should be on the efficient frontier, those are things which are too complicated for us to model. Like, for example, I just give you one example. For your forward-looking estimate should, certainly for individual stocks, consider the news. Can we leave a computer to look at the news and do accordingly? Well, not too many days ago, there was a hacked news service which came out with a report that there was a bomb going off in the White House or something like that, and an automatic news reading program said, "Oh my God, let's sell." And okay, so I am not artificial intelligence is still a long way from doing what this thing does, and you got to have different kinds of this things. People who are good at making forward-looking estimates, and people who are good at reminding these other people that there's uncertainty, and people who are good at doing frontiers, and people who are good at understanding clients, and so on. So in the right hands, mean variance analysis is as flexible as a set of oil colors in the hands of Picasso or Van Gogh, or Rembrandt, and in the wrong hands, it's just paint by numbers, and you don't know what you're going to get.
That's a great point. So one last quick question, and then we'll wrap it up. But I thought it was a great one. One of the viewers asked what your favorite book is that you've read recently.
Read recently? Well, first let me tell you the book I read that started all this, and the one I'll tell you the best one I read recently. When I was in high school, I was a nerd. This was before nerd. The girls knew that nerds could make money, and so I was a nerd even before it became popular. And I read science at a popular level, like the ABC of Relativity, and I read the philosophers at the originals. So my favorite philosopher was Hume, who said, despite the fact that I released this eraser and it keeps going down 100 times, 1,000 times, I still have no proof positive that I have no necessary proof positive that it will go down the next time. Or to put it another way, even though Sir Isaac Newton's universal law of gravity had been confirmed tens of thousands of times, did not prove that there wouldn't come a time when some phenomena would be observed which was not consistent with it, as we know, as did happen. Okay, so that was actually before I had read, or in time written before that, was Descartes' first meditation. What do I really know? I can doubt this, I can doubt that. All I know is I think, therefore I am. And somebody says, well, that has no applicability to finance. I mean, well, what do I really know? I read an earnings number in the Wall Street Journal. Well, maybe it's a lie. Maybe it's an honest mistake. Maybe it's a misprint. Maybe it's the truth, but you don't know the definition of earnings that he was using. So, the Wall Street Journal is just full of hypotheses, and so that's Descartes' exercise, Hume's dictum that you. So this leaves us in a awkward position. Then many years later, I go into, or a few years later, I go into economics. I'm attracted to the economics of uncertainty, like von Neumann and Morgenstern's theory of games. And I have as one of my professors Leonard J. Savage, who made us all Bayesians. And in effect, he asked, he said, he doesn't think of himself, he didn't think of himself as a philosopher, but in effect he said, don't ask what do I know, ask how I should act. And so that was a great revelation. So anyway, so my historically Descartes' first meditation, second meditation. He's off. I'm not with him. Hume's Inquiry into Human Understanding, Phenomenon Morgenstern's Theory of Games and Economic Behavior, and Leonard J. Savage, Foundations of Statistics. Now, it turns out that a grandson of mine convinced me that I should read some fiction. He gave me a reading list. So I figured, for a grandson, I should read. So I tried reading Henry Miller's something. Oh, it's horrible. Oh, boring, like a law. And then I read The Alchemist. And I think it was wonderful. So, The Alchemist. I can't remember. There's a South American author whose name I'll mispronounce, so I won't. So that's my most recent, most enjoyable reading.
Great. Well, thank you so much, Dr. Markowitz.
It's been.
I think we could go on forever having these conversations, and hopefully the viewers have enjoyed hearing some reflections from you. As a reminder, this webcast will be available for replay on the CFA Institute website. And once again, thank you to Dr. Markowitz for the time.
My pleasure.